The Fed's two-day meeting getting underway today, and while no policy changes are expected, the outlook for rate hikes is starting to shift. And for that, Steve Leisman has the results of the latest CNBC Fed survey. Steve.
Good morning, Andrew. Yeah, the CNBC Fed survey shows the market has sped up the timeline for Fed tightening, potentially putting the Fed and the markets at odds over the policy outlook. Respondents now see the Fed hiking rates for the first time in November 2022 and ending QE or asset purchases in November 2021. That's later this year. 63% of the 43 respondents say the $120 billion of monthly purchases are not needed either for the economy or the markets. And 83% say the $1.9 trillion Biden relief package was too big. Back in September, respondents forecast the first hike February 2023. Now it's November 2022. So that's about 3 or 4 months later. Better vaccine and economic news have played a part, obviously, but the huge amount of fiscal relief has also been a big factor. Robert Brusca, chief economist at Fact and Opinion Economics, writes the stimulus package is too big and poorly allocated. Much of the money will not get into a productive spending stream to create stimulus. But Joel Naroff of Naroff Economics says $2.7 trillion, that's the last one and this one here, in stimulus in 1 year should lead to a booming economy. Even though inflation and interest rates may rise, they are only getting back to more normal levels faster than expected, and that is good for the economy. So two views there. Well, back in December, the 10-year was forecast to rise modestly this year to 1.25%. It's already surpassed that at 160 and headed to 2% this year and 2.4% next year, according to respondents. And the 2.4% level, that's also the average response for what it would take to bring the Fed into the market. So little expectation at this point that the current yield, the Fed would ride to the rescue of bondholders. Andrew?
It's going to be fascinating to see what's going to happen. You know who we have in the next hour, do you?
Well, you got Jack Lew coming up and Judy Shelton, I think. Is that who you're referring to?
That's who I'm referring to. I want to know what you want to know.
Well, I mean, I read Miss Shelton's last piece in the Journal, and I think she's very much against all of the things the Fed has done. And I think you could make an argument somewhere along the line that maybe what they're doing now is too much. But, was all of it too much, I guess is the question you might ask her. I'm also interested in this idea of, and maybe Jack would talk about this, other central banks have expressed their concern with higher bond yields, but this Federal Reserve has not. So I'm interested, does he think the Fed needs to come in at some point or be prepared to come in at some point? And of course, Andrew, the question is this. The Fed had a forecast, and it was perhaps not based on, first of all, the blue wave coming and then the extra $1.9 trillion of stimulus, and why that does or doesn't change the Fed's own policy outlook. If you look at the forecast or the dot plots, Andrew, they don't really have rate hikes until 2023. Markets moving that forward. Not that significant that the Fed and the markets are out of whack for the next couple of years, but it'd be interesting to see how they would realign again.
Shepard Smith here. Thanks for watching CNBC on YouTube.